A month ago, buyers were cautiously optimistic. Mortgage rates were sitting in the high 5s to low 6% range. Inflation wasn't out of control, and expectation was that the Fed would cut rates twice in 2026. Then a war broke out in the Middle East, and in 30 days, mortgage rates shot up by more than half a percentage point. Most buyers have no idea why. In this video, we're going to explain exactly what happened, what you need to know about it, and how you can make this work in your favor. I'm Karl Kyler, your San Diego realtor, and this is your April mortgage market update with Matt Kish from Movement Mortgage. Each month, we break down what moved mortgage rates, what the bond market is telling us, and what buyers and sellers in San Diego need to be thinking about. This isn't hype, it's clarity. It's built to give you the confidence to make a smart decision, whether you're buying or selling, or even just sitting on the sidelines. Now, let's get into this. Here's where rates are standing right now, according to Mortgage News Daily. The 30-year fix is sitting around 6.5%. The 15-year fix is about 6%. Jumbo loans are slightly higher than your 30-year conventional, and as for your VA and FHA, they are looking extra attractive, sitting just under 6%. Here's what puts those numbers into context. At the start of March, the 30-year conventional was sitting around 6.1%. By the end of the month, it had climbed to over 6.5%, nearly half a percentage point added to your mortgage in a single month. On a $750,000 purchase in San Diego with 20% down, that half point difference adds up to roughly $200 on your monthly payment. And that's not a rounding error there. That's real money every month for 30 years. Always keep in mind, these are national averages. Your actual rate depends on your credit score, your down payment, your loan type you're using, and how individual lenders are pricing at the time that you're looking into a loan. Now, you may have noticed something in those numbers. The FHA rate is reasonably lower than that 30-year conventional. An FHA loan requires only 3.5% down, which makes it accessible to more buyers. But FHA also carries what's called mortgage insurance, a monthly premium that gets added onto your payment as a cost of the government's backing it. So I asked Matt Kish over at Movement Mortgage to break down whether an FHA loan makes more financial sense right now than the conventional loan option, given the rate difference, even when you account for the mortgage insurance premium. Let's take a listen to what he had to say.
FHA does make sense sometimes over conventional loans, right? It's got to be the certain scenario, but a lot of times you're seeing people and borrowers with strong credit looking for FHA loans to try to bridge gap the difference in rate. And certain points that does make sense, but if we're putting more and more money down, we're going to see that make sense less and less, right? So apples to apples, if we're looking at a conventional product that allows first-time home buyers to put as little as 3% down, and we're weighing that against the 3.5% down option with the FHA, that might be something apples to apples we want to look at if we have strong credit. But FHA is kind of based off of credit, folks that don't have the strongest credit, right? And that's why we need FHA loans. That's why you get a little more love in the rate, because there's other finances that you have to deal with on FHA loans. And with strong credit, if we're thinking about putting more than that 3% down, if we're thinking more closer to 5 or 10 or 15, we're really going to probably want to look at a conventional loan with strong credit because of the costs that are associated with FHA loans. Not only is mortgage insurance attached to every FHA loan for the duration of that entire loan. So you really can't have an equity stake and refinance out of that mortgage insurance like you can a conventional loan, right? But the biggest hit is not so much the private mortgage insurance that's going to carry, because you're going to have that whether you have a conventional loan or an FHA loan. It's actually the funding fee that the FHA carries with it, right? So if you use an FHA loan, you have to finance 1.75% up front with the FHA funding fee on a $700,000 purchase. Or a $700,000 loan, that's $12,250 additional tacked on to that 30 years and amortized that way. So it's really got to make sense. But if you got a strong credit and you're looking at the FHA side, the only way to really gauge that is kind of, looking at it apples to apples, 3% down to 3.5% down, or maybe even 5% on a conventional side. And obviously, we're going to break down those numbers for you and show them to you live. And so you can see for yourself, what does this monthly payment look like, FHA versus conventional, with this amount down? And most of the times with strong credit, you're going to see that the more you put down on a property, less and less FHA is going to make sense if you have strong credit.
Now, moving on to our next topic, the Iran war oil shock. Why a war in the Middle East is changing your mortgage rate. Mortgage rates follow the bond market. More specifically, they track the yield on the 10-year US Treasury note. When bond yields go up, mortgage rates go up with them. In March, bond yields shot up really fast, and the reason had nothing to do with the Federal Reserve. You already know about the war with Iran. What you may not know is exactly what it did to oil prices. As part of the escalation, Iran blockaded the Strait of Hormuz, a choke point that carries about 20% of the world's daily oil supply. Oil went from about $65 a barrel at the end of February to over $110 a barrel by late March. That's nearly a 70% increase in roughly 5 weeks. And here's the chain reaction that leads to your mortgage rate. When oil prices spike, inflation expectations spike with them. Gas gets more expensive, shipping costs go up, groceries follow. The bond market, which is made up of large investors who are constantly pricing in future inflation, responds by demanding higher returns on treasury bonds. They're essentially saying they want more yield because they're expecting rising prices to eat into their investment. When bond yields rise, mortgage rates follow. The 10-year Treasury started March at 3.96%. It ended the month at 4.35%. That's nearly a 40 basis point move in less than 30 days. The mortgage rate followed nearly the same path. If you're wondering about the Federal Reserve, the Federal Reserve held rates steady at their March 18th meeting. But this story was never about the Fed. A naval blockade thousands of miles away changed the cost of borrowing for every single buyer in San Diego. I had to ask Matt Kish how he's seeing this play out on the lender side right now. Are lenders adding premiums on top of their normal pricing? And for buyers who are mid-process or about to start, what's the strategy on rate locks when the market is this volatile? Let's hear what he had to say.
I actually have a couple of live scenarios where this has taken place, right? Because this volatility kind of came out of nowhere and has really hit us in the last 60 days. And so we've kind of been in a little bit of longer escrows, and we've been trying to bob and weave with this tumultuous rate environment. And we saw in real time that locking 60 days out might have been a better idea than waiting until today to lock in that interest rate, given the loan criteria, credit criteria, and things of that nature. Nothing was going to change in that 60-day range with our borrower to advance his credit stake, or maybe getting a pay raise to bump up a better rate for him on his own, and not just letting the market play out. But as it was, we could have locked in a 60-day rate with about 0.25% of a charge. Seeing what the market did over the last 60 days, we definitely lost that quarter of rate. So we were lucky that we found a hole in this market, that we really got a rate that was favorable for us. But boy, it would have been advantageous for us to lock in a little further out. And we talked about this with our borrower once the war started going in Iran and the oil prices really jumped up, and overnight we saw rates really take a hike. And so we had these conversations, and it was like, let's hold, let's see what happens. And it could have really bit us in the rear. And we were fortunate in our scenario that we weren't bit, but it would have been advantageous for us to lock a little further out this time, knowing what we know now. But again, if we have that crystal ball ahead of time, we would never ever be in this position. But this was one of those positions, and one of those market moving situations, to where, man, if we had a time machine, we would have gone back and probably locked things differently.
The final topic for today, stagflation risk. What happens when you get high inflation and a slow economy at the same time? Stagflation is when you get inflation and recession operating in the same window. High prices, slowing growth, and a Fed that's stuck. If they raise rates to fight inflation, the economy slows further. If they cut to boost growth, inflation gets worse. There's no clean exit from this. And here's why this all matters right now. Oil is above $100 a barrel. That pushes prices higher across the board. PCE, the Fed's preferred inflation gauge, is sitting at 2.8%, above their 2% target. And at the same time, Goldman Sachs put the odds of a US recession this year at 25%. The March jobs report came in at 178,000 jobs added, triple the forecast, which tells the Fed that the labor market is still hot and inflation isn't going anywhere. And then there's a CME FedWatch tool, which tracks where large money managers are actually putting their money. Now shows nearly a 70% chance the Fed holds rates exactly where they are through the end of the year. 1 month ago, that expectation was 2 cuts. Now there's even an 11% chance that a rate hike is possible by December. For buyers and sellers in San Diego, stagflation is one of the worst environments. Sellers don't want to drop their price because everything costs more. Buyers can't catch a break on their monthly payment. Volume freezes. That's what we're watching for. So I asked Kish for his honest take from the lender side. If stagflation becomes a story for 2026, what happens to mortgage products and lending standards? And what should a buyer be doing right now to put themselves in the best possible position, regardless of where this all goes? Let's take a listen.
We're kind of in the middle of something here. We could be heading towards stagflation, but on the flip side, we could be heading towards a recession, right? So we're really caught up in the middle of something that we're going to find out. Again, if we had a crystal ball, we would really know more about it, but we're going to find out at the end of this year which direction we're heading. Are we heading towards stagflation, or is it going to be recessionary measures in which the Fed will do, kind of 2 different things. But on the lender side, stagflation, you're going to see a lot of the non-QM stuff be put on hold. A lot of investor driven stuff, DSCR loans, where they take in the rent considerations, because you're going to see rents move as well. So a lot of investor heavy stuff, non-QM stuff that, where we're not using traditional credit standards, Fannie and Freddie to kind of guideline us. So you're going to see a lot of those investor packages kind of be put on hold. You're going to see jumbo loans. You're going to see those rates and those guideline standards kind of really tighten up, because these are the things that investors and banks really put the clamps on when money is tight. And you're going to see condo guidelines get even sharper. And we kind of saw a small glimpse of this in 22, 23. We had a little bit of stagflation there. And we saw that. We saw that the non-QM stuff kind of be put on hold, or the guidelines of those really be tightened down. And as well as the jumbo pricing, man, we saw jumbos kind of really go crazy. So that's when you saw a big hold on those higher purchases. People really waited on the sidelines 22, 23 because of the guideline standards in the stagflation environment. But when it comes to recession, on the flip side, you might see not right away, because nobody really knows you're in a recession until you're in it. And so when we know and those wheels are turning, the Fed will have no choice but to cut rates. But on the flip side, you're still going to see investors in that market want more spread on the risk. So what does that do for rates? You're going to see a lot of people go towards the 10-year treasury because that's a safe bet. So what is that going to do for rates? And we know that rates right on expectations as well. So what does an expectation of a recession look like in the rate market? So there's a lot of these factors that are still yet to be untold. We're really going to find out by the end of this year, because it doesn't look like the economy is going forward in a great place, right? We're seeing still a lot of layoffs. We're seeing not much job growth. We're not seeing a lot of people moving from their jobs. So the economy is in a weird spot, especially with the war going on. So it's a very big wait and see. And I don't think the Fed is really dead set on doing anything until they know which way it's going to go. So I really don't expect Q2, Q3 to be much movement with the Feds really wanting to cut or raise rates, because they're in the same kind of position as us. We really don't know.
Here's what March 2026 taught us. Rates don't just respond to economic data anymore. Geopolitical events can move them just as fast and just as aggressively. And that's the environment we're operating in right now. The Fed isn't cutting rates anytime soon. Oil is keeping inflation sticky, and for buyers in San Diego, this market rewards preparation over waiting. Near term, expect rates to hold between 6.3 and 6.7%. Oil above 100 pushes it to the top of that range. The only thing that changes the picture is a Middle East resolution or a clear economic slowdown, neither of which is on the horizon. And that's your mortgage market update from March. For the full San Diego housing market picture, including inventory prices and what the local data is actually saying right now, check out the San Diego Market Matters series right here on this channel. That's where I break down the local numbers every month in extreme detail. If you aren't subscribed yet, let me put it this way. The subscribe button costs you nothing, and the next geopolitical shock to mortgage rates is already somewhere on the horizon. Be ready for it. Hit the button. As always, I'm Karl Kyler, your San Diego realtor. I'll see you next video.